From New York City for viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, President Trump sparks fresh waves of market volatility. U.S. consumer sentiment surges to a 5-month high. And solid economic data gives the Federal Reserve all the more reason to pause. We begin with the big issue, the world's view of America.
If you look at the economy today, there's a lot of good short-term things.
That U.S. sentiment is unabated.
The U.S. has been really an incredibly strongly performing market, strong economy.
People are confident in America today.
We do have the best economy in the world.
We continue to be positive on the U.S., right? I mean, there's a lot of economic growth.
I think you have to be optimistic that if we can grow the economy.
We have good inflation. We keep on powering forward growth.
We're constructive that inflation's more under control.
We have a risk that we may be underestimating what inflation could do in 2026.
The fundamentals, or at least for the first half of 2026 in the U.S., are still supportive, but not without volatility and noise.
All that debating has left its mark on the benchmark 10-year note. The yield on the 10-year this week broke out of its trading range, and that is that red band there, which covers roughly 4.1% to 4.2% over the past 7 weeks. In doing so, the 10-year yield rose above its 200-day moving average, the long-term trend line. On Tuesday, you'll see that the 10-year yield jumped to as high as 4.3%. Now, one major catalyst for that jump was the historic sell-off in Japanese government bonds, particularly at the long end of the curve. The yield on 30-year JGBs, that is your white line, had their biggest daily leap on record, while the yield on the 10-year, and that is your purple line, is back to its high since 1999. Not so long ago, it held below zero for years by the central bank. Traders adjusted their inflation outlook after the new prime minister considers a tax cut on food to shore up support before a snap election. Citadel's Ken Griffin believes that the rout in JGBs is instructional for the U.S.
Is there an implicit warning, Ken, in that sell-off for the U.S. Treasury bond market?
Actually, there's an explicit warning that if your fiscal house is not in order, the bond vigilantes can come out and extract their price. If U.S. Treasuries are viewed as being at risk because the United States is not seen as being creditworthy, that will result in bonds having a much higher demanded yield in the marketplace. I think that what happened in Japan is a very important message to the House and to the Senate. You need to get our fiscal house in order.
All right, a lot to dig into here with our macro roundtable. Kathy Jones, Chief Fixed Income Strategist at the Schwab Center for Financial Research, joins us along with Russ Brownback. He is Deputy CIO of Global Fixed Income at BlackRock. Folks, thanks for joining us so much. I guess I want to start big picture here, because whether you call it Sell America or the end of U.S. outperformance, the events of this week may result in reduced demand for U.S. Treasuries. Katie Koch, the CEO of TCW, calls it a quiet quitting, where global investors are looking for opportunities to diversify away from the U.S. And we've seen how India's holdings of Treasuries have fallen to a 5-year low now. Kathy, how big a risk is the rest of the world selling U.S. Treasuries?
I think it is a risk over the long run. I don't anticipate just a wholesale selling, waking up one day and saying everybody dumping their treasuries, because there's still not an easy way to replace treasuries wholesale. But I do agree that the inflation risk exists. The fiscal deficits are coinciding with a lack of confidence in the U.S. ability to deal with them and to deal with a number of policy issues. And this disruption, or this rupture with many of our closest allies, would lead to less demand for treasuries and investors buying treasuries to want a higher yield. Mm-hmm. And I do think that Japan is instructive in that sense, that worries about the fiscal policy is going to have an impact over the long run on demand for treasuries.
Russ, what's your take?
So I would tend to agree. I don't think we're anywhere near a solvency tipping point for U.S. Treasuries. In fact, you think about the wherewithal systemically. There's $26 trillion of cash on the balance sheets of the private sector today. That's more than all marketable treasuries outstanding net of what the Fed owns. So, and then you talk about foreign demand. Foreign official demand for treasuries has definitely mitigated over the past decade, but that's more than been offset by private sector flows into treasuries and broadly U.S. assets from private investors. So I think the yield curve's in equilibrium today, and I understand you can't run massive deficits in perpetuity. It creates a vulnerability, but we aren't on the brink of any kind of systemic issue at this moment.
Right. Perhaps it's more of a marginal move away from treasuries at this point that will take years to kind of unfold. When we think about what we saw in Japan, the sell-off was marked by a lack of breadth. For instance, just $280 million of trading pushed the $7.2 trillion JGB market into meltdown. Could the U.S. market, Russ, be similarly dominated by buyers with shorter holding periods who then move in and out of these securities more quickly than in the past?
So I think the price action in the Japanese market is more idiosyncratic. I think there's a worry that it spills over and becomes contagious. There are different fundamentals at play. You have a different structural supply-demand balance there that's not so favorable to the back end, which we don't have in the U.S. And there's a huge prevalence of fast money and momentum players there. So a lot of the move you had this week in that market was a forced unwind of levered players. The popular bet was having flatteners on, so long the front, long the back end, short the front end. And then when you got a piece of news that went counter to that, everyone had to exit stage right at the same time. It exacerbated the price move. Here's a great stat for you. In the U.S., only 8.8% of treasuries outstanding net of what the Fed owns are 20 years and longer. There's about $2 trillion. There's far more long duration assets under management in the U.S. than there are treasuries to buy. So that problem is not near in the U.S. where it is in Japan.
All right, so you're not comparing like with like here, but Kathy, I wonder, as we talk about the spillover from the higher yields in JGBs, do Japanese investors perhaps take money out of U.S. treasuries in favor of those fatter yields at home?
Yeah, you can buy JGBs and hedge, have a higher return than buying U.S. Treasuries with a hedged currency. So clearly there is a risk that you see some of that money flowing back. Again, I don't think that we're on the edge of some sort of disaster. I think, though, that what we're seeing is this gradual move where the market is demanding higher yields to offset many of the risks that we have, and this marginal decline in demand, and that can continue to pull up long-term yields in the U.S. and expand that term premium that's been moving up gradually over the last year or so, and I think will continue likely to rise from here.
One of the most popular trades of 2025, Russ, was betting that short-term debt outperforms long-dated bonds. And we're seeing yield curves steepen globally in the U.S., in Germany, in Japan. Does this trade have more room to run?
We think it does. So, listen, I think the back end of the curve is always going to gravitate toward nominal GDP growth outcomes. The front end is going to be anchored to where it thinks policy rates are going. And so the steepening you've seen over the past couple of years is in deference to the idea that the central bank has threaded the needle. They've enabled a soft landing. We're very much in the camp that the data will unfold this year. We think we're at a productivity revolution. So we think the Fed will be able to deliver more rate cuts, even though growth is pretty strong. And we think that does result in a bull steepener, meaning it'll be led by the front end moving lower, not so much the back end moving higher. We don't think it's a huge move, but we do think the move will be downward in yields at the front end of the curve.
Yeah, BlackRock's Tom Becker says markets are underestimating the risk that inflation will remain persistent in the U.S. as well as the UK, and then also get in the way of anticipated rate cuts. Kathy, he's been selling both treasuries as well as gilts. This is not the consensus view necessarily, but is that idea perhaps gaining some currency?
Yeah, we're concerned that the Fed doesn't have as much room to cut as I think the markets are anticipating, and that inflation will continue to be somewhat sticky. We've got, the influence of the One Big Beautiful Bill coming in with some fiscal stimulus, and an economy that's running fairly hot. So we are looking for steepeners, but more of a bear steepener than a bull steepener from here. Maybe one or two, maybe one rate cut, but it looks like it may be put off until June or so at this stage of the game. just because we have a hotter than expected growth rate and stubborn inflation just doesn't open the door to a lot of rate cuts. So more of a bear steepener than a bull steepener from here.
Russ, what do you expect to learn next week? We're not going to get a dot plot. We're not going to get a rate cut likely on Wednesday. What is Jay Powell going to say that kind of sets the tone for the rest of the year?
I think we're not going to get any price, any policy change, but I think they're going to signal. Last Fed meeting in the press conference, they talked an awful lot about this productivity evolution, which is nascent. I mean, it's coming at us very quickly. Agentic AI is a very new thing that's evolving at an exponential rate. I expect you'll hear a lot more about how the economy can grow in a non-inflationary way. And the worry will be, what does that mean for the labor market? And by the way, when you're not going to move the policy rate, probably this meeting, and if they do move it, which we think they will later this year, it won't have a huge impact on duration. That's why we're calling it an income regime today. So you want to harvest income, not think about fixed income as a big sort of bet that rates are going to move up or down, but to harvest the income that's available at generationally high interest rates.
Kathy, what about you? How do you see the rate decision, the press conference next week, setting the tone for how investors should allocate within fixed income?
Yeah, we don't expect any change in policy. We won't get a lot of updates on the economic outlook. I'll be interested to see what the statement has to say about the labor market, because the signals there have been a little bit confused and mixed, but I think the message will be steady as she goes, and that the Fed has given itself a timeout. For us, we've been advocating kind of an intermediate term, high quality portfolio where you're clipping the coupon, getting total return from that income stream and maybe a little bit of capital appreciation. We think it's a good time to play it kind of down the middle rather than taking too much duration risk, too much credit risk. Let this period of volatility, I think, that we're going into for the first quarter, maybe the first 2 quarters of the year play out, and then see where we land and see where the opportunities present themselves.
All right, good stuff. Kathy Jones of Schwab and Russ Brownback of BlackRock, thank you so much for joining us this morning. Up next, we've got the auction block. Netflix lining up billions to fund its purchase of Warner Brothers Discovery. This is Real Yield on Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is time now for the auction block, where we kick things off in Europe. A handful of sovereign transactions lifting market-wide issuance to 62 billion euros. That falls short of estimates as volatility forced several borrowers to the sidelines. In the U.S., junk bond sales getting a big boost from falling risk premiums. 8 borrowers raised almost $6 billion on Thursday alone, marking the single biggest day since last September. Here in the U.S., a holiday-shortened week weighing on investment-grade debt sales. Weekly issuance set to finish at roughly $20 billion, falling well short of dealer estimates calling for $25 billion. Also, let's look at the financing picture that's developing in Netflix's bid to buy Warner Brothers Discovery. Netflix has lined up $67.2 billion of financing from Wall Street banks, making it among the biggest loans ever. And of course, on Tuesday, Netflix amended its offer to say it would pay entirely in cash as opposed to stock and cash. Now, sticking with credit, Standard Chartered CEO Bill Winters sees safety in the system.
There's been a structural shift of capital from the banking system into non-banks globally. The good news is, and these private credit buyers, whether they're mutual funds or big asset managers or dedicated private credit funds, they're not very leveraged, much less leveraged than banks. So if we do have this appearance of credit losses, if the credit cycle manifests itself, which it will, the credit cycle is not dead, so of course it's going to come back. And credit cycles are fine when the financial system has to delever quickly, great financial crisis being the big example, then the credit cycle becomes amplified by hundreds of times. It doesn't feel like we're there because the system is just much, much safer and sounder than it has been.
Let's dig into all of this with our credit roundtable. I'm pleased to welcome Stephen Oh. He is co-head of leverage finance at PineBridge Investments, and also joining us, Will Smith, head of credit at AllianceBernstein. So this week saw a sell-off in Japanese bonds and President Trump's push for U.S. control of Greenland. Investors clearly unsettled, and we saw the dollar, treasuries, equities sell off. Yet you look at credit spreads, and they keep tightening despite all these headlines. and investment-grade credit risk, or I should say credit spreads, at the tightest in 3 decades. Has U.S. credit, Stephen, become a haven for some investors now?
Apologies, my audio just went out there, but trying to pick up what you talked about with the initial conversation there. You know, with respect to credit markets being very tight right now, I think it's fair to say that the fundamental outlook, both from an economic standpoint as well as from a corporate earnings and corporate balance sheet standpoint, are very supportive and positive for tighter credit spreads. And even though we've seen a fair amount of volatility within government bond markets, really heightened by both fiscal concerns as well as geopolitical concerns, you've seen a great amount of stability. There's a belief within the marketplace and by credit investors that corporate credit will be able to withstand, some of the volatility much more so. So what you have in effect is less of a broad-based concern about some type of valuation issue or a shock in the credit markets. What you're really dealing with more is idiosyncratic concerns that could negatively impact specific issuers. Mm-hmm. And there's pockets of industries that are struggling right now. But overall, I think we're in a credit market environment where the good news is fundamentals are good, valuations are tight, so the outcome is really more of a yield clipping type of environment.
Will, what strikes me, though, is that within credit, high yield spreads tightened, especially the triple Cs, the worst part of credit, despite the turmoil, despite the headlines. Why is that in particular?
Well, if you look across credit markets, investors are still very discerning. They're not willing to go into the lowest quality part of markets. So if you look at investment grade, triple Bs trade wide versus everything else. If you look at loans and bonds, triple C bonds, in high yield, trade cheap to the rest of the market. So it's really coming from this point of, well, the lowest quality part of credit markets are the cheapest. And to the extent we don't actually see any sort of a material growth slowdown or a shock that's large enough to really widen credit spreads, then that part of the market is just really underowned and has a lot of room to rally. And I think that's really what you're seeing this year.
But do you think someone is being fully compensated for that credit risk on the junkiest part of the junk bond market? Well,
it's always a debate within triple Cs. It's an area that takes the bolus of defaults within leveraged finance. It's roughly 80% of defaults in the high yield bond market come from triple C rated bonds. Now, it's really just a matter of when those defaults happen and the size and scope of them. And the reality is for most of the cycle, you're not going to see defaults be large enough to really eat into the income levels that you can earn in triple C bonds. However, when you do get that sort of growth slowdown, that recession, and defaults balloon, that's when you take significant losses. So it's really about the timing. And so far, it seems like we've been able to continuously push off that recession.
Stephen, what do you think?
There's two aspects of the triple C market and why it's been trading so much wider. And one is the fact that rather than being a crop of triple Cs, which are good performing but simply over leveraged, you've got a lot of businesses that comprise the triple C that are facing, secular and structural issues. And can their businesses compete? And what are the expectations of their outlook from an idiosyncratic standpoint? The other thing that we've really been having within credit markets, and I've been talking about this over the past year, is while there's been a lot of talk about a K-shaped economy, we've had a K-shaped credit markets. Credit investors have insatiable appetite for credits that are deemed to be performing well, but there is a substantial aversion with respect to businesses that are struggling, even if the yields look enticing. And so, I think you've got this demand function right now, and it's particularly pronounced in the leveraged loan market versus the high yield bond market because of the dominance of CLOs, that you do get this sort of a K-shaped type of credit market environment.
Well, speaking of CLOs, I wonder about the JGB sell-off, the spillover from those big moves there. If Japanese investors who are big buyers of CLOs here in the U.S. do start moving some of their money home to take advantage of higher yields, wouldn't that dent the foreign bid for U.S. credit?
I think it's a concern. Sorry, go ahead.
Oh, sorry, Stephen. Yeah, I was just going to say it certainly could slow that demand down. Now, the reality is what would really change the story for Japanese investors in particular is if the BOJ started hiking rates, because it's really about the front end in terms of the cost to hedge back into yen. So if that were to change, and maybe you're seeing the Fed cutting rates at the same time, that could really change the dynamic and make those asset allocations globally look quite different. However, just broadly speaking, you have seen a compression of things that are not investment grade to investment grade corporates, right? I mean, a lot of high quality buyers will look at things like agency MBS as an example, something they can buy, AAA CLOs. And those things have all compressed versus US investment grade. In a lot of ways, that makes US investment grade look a little bit better.
Stephen?
Yeah, I think the demand for, all U.S.-based fixed income, not just credit, but CLOs and treasuries as well, is going to experience a little bit of a headwind from the standpoint that, when you hedge back JGBs and you have to get a premium to invest in U.S. assets, the incremental yield just simply is not there anymore. And in fact, in many cases, yields are better in the local markets. We don't expect that the Japanese investors will sell U.S. assets, but marginal and incremental demand of additional capital are more likely to be steered toward the local markets given the differentials.
Right, so it's not so much a wholesale move out, it's just in terms of allocation of future funds. Stephen, thank you so much. Stephen O of PineBridge Investments, and Will, thank you as well. Will Smith of AllianceBernstein for our credit roundtable. Still ahead, we've got the final spread, which is a look at the week ahead. The Fed's first rate decision of 2026 is on deck. This is Real Yield. This is Bloomberg Real Yield. I'm Scarlett Fu. It's time now for the final spread. The week ahead. Coming up on Monday, the Asian Financial Forum kicks off in Hong Kong. On Tuesday, the Goldman Sachs Macro Conference kicks off. And on Wednesday is the Fed's first rate decision of 2026, followed by a press conference from Fed Chair Jay Powell and big earnings from big tech. On Thursday, Apple reports results and the EU foreign ministers will be meeting in Brussels. And we move ahead to Friday, earnings from big oil, Chevron, Exxon, Verizon, and American Express due to report as well. Plus, we get wholesale inflation. And for my final thought, President Trump expected to announce his first Fed chair pick as early as next week. Remember, the Fed decision on Wednesday. From New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield.